and welcome to FSB's final webinar in conjunction with Alika Bank and British Business Bank. My name is Sian Brennan-Todd. I'm a professional MC and I'll be your host for the next 60 minutes. Now, I'm delighted today to be joined by two industry experts, including Conrad Ford from Alika Bank and Paul Sullivan from the British Business Bank. In today's session, we are going to cover the UK's business finance landscape and where to start, the range of debt funding options available to small businesses, what funders typically look for, and how to prepare your business for investment, the common pitfalls and risks when seeking finance and how to avoid them. We can provide practical tips on improving your business finances readiness and find out how the British Business Bank supports smaller businesses through tools, information and regional networks. Now, please do use the questions to panelists buttons to send over any questions and we will endeavour to answer as many as possible, plus those ones that we have already received in advance. Now, today's session will be recorded and shortly available on our on-demand page on the FSB website in case you want to watch it again. Everyone who has registered will tomorrow receive an email with the link and all further links and information that we have provided in today's session. Now, I will hand over firstly to Conrad and then to Paul, move on to our Q&A.
Hi everyone, nice to meet you. So let me just briefly introduce myself. I'm Conrad, I'm on the leadership team of Alika Bank, which is a bank that's exclusively focused on established businesses, so businesses typically with 5 or more employees. But I've been in the sector we're about to talk about for a long time. And prior to Alika Bank, I founded what is Europe's leading comparison site for small business lending. So I stay very interested in this segment and hopefully we can give some useful insight from the time that I've spent there. I'm going to kick off by firstly talking you through a couple of high-level considerations to think about with funding. I'm going to first talk about things to consider before funding your business. And actually, I'll open by saying, ideally, of course, you want to think about funding as early as possible. It's surprisingly common for businesses to kind of realize that they are going to struggle with payroll next week. And then they get themselves into a situation where their options are limited and often not that great. Now, of course, I'm a business entrepreneur by background, like you guys. And I know that sometimes that just happens. That is the nature of things. But wherever possible, it's best for your business and for you personally to try and get on top of finance and funding in advance so that you can do it in a thoughtful and measured way. So yeah, I'm going to talk about what I call the 5 C's to how to think about funding. And on each of these, I'm going to give you one key takeaway. So in other words, ignore everything I say if you want, but please don't ignore the takeaway because some of these are really important for your own personal circumstances and your personal well-being. So the first of the C's is circumstances. So it's important to think about the circumstances that you need funding for. Because it's really different. It's very different if you need money to make payroll temporarily to whether you're investing in your business over many, many years. And actually a good framework, as we'll see in a minute, is to kind of frame it through how you think about your personal finances. So if you're going to buy a house, you wouldn't do it with payday lending, but equally, if you wanted to a bit of money just to book a holiday before payday, then clearly you're not going to get a 5-year mortgage against your home to do that. So a good framework is actually how you think about your personal finances. So there's of course many reasons that can drive finance. So you can be a seasonal business like a hotel, need finance in the winter months. You can have a new contract. You can have long-term investing. So for example, the business is ready to take the next stage, maybe open its second branch in another town. And then of course, there's situations of turnaround. My one key takeaway on circumstances is unfortunately, very often businesses will be in a hole and keep digging by raising further funding. Now that is sometimes the right option, but as we'll talk about later, done badly, that can actually cost your personal finances as well as your business as well. And actually in our industry, we use the phrase management actions. So when we talk about how a larger, sophisticated business deals with a difficult situation, management actions is the things that business is doing to kind of get itself in a state where with funding, on the other side of the funding, it can be in a better state. So it's things like headcount reductions, for example, if it's lost a major contract. So circumstances are important. And then there's capacity. So how much funding do you need? I think the most important thing is to be realistic. So in other words, you're probably going to need a bit more than you think in most situations, particularly in a complex situation like a new contract. You maybe want a bit of a buffer, but equally you don't want to be paying for funding that you don't use. And in some cases, by the way, you will be paying for funding you don't use, but as obviously you want to limit that as much as possible. And a key takeaway here, and this is probably the most important takeaway, commercial finance, as we call it in the industry, so lending to businesses, is largely unregulated. It's a sweeping statement, but it's largely true. What does that mean? Well, if you buy a financial product as an ordinary person, well, of course, we're all ordinary people when we close our front doors at night, then you have a lot of protections in most circumstances. You'll very commonly have what's called a key facts document, which basically lays out in plain English and in a comparable way the different terms of the insurance you're buying or the mortgage you're buying or the investment you're making, because it's regulated. And indeed, if the finance provider doesn't disclose key things on that document, they're on pretty shaky ground. Lending to businesses, largely speaking, particularly businesses that are limited companies, incorporated, it's largely speaking is unregulated. So don't expect a key facts and don't expect that there's a regulator who's going to step in if things go wrong and help you out. Then we have costs as well. Costs can be very complex in business lending. There's many types of fees. So for example, if you're funding your invoices, what's commonly called factoring and invoice discounting and various other products like that, then I still get confused by some of the terms that I see in documents. Often you have the same thing as different names depending on the provider. My one takeaway on cost is, do you understand the costs if things go wrong? So in other words, we all, as business owners, we're optimists by nature. That's why we set up businesses. But have you thought through, do you understand the cost of the finance if things go wrong? Because unfortunately, because it's an unregulated market, there are some disreputable providers, and they will probably take advantage of you financially in a circumstance you got it wrong because you haven't read the small print. So read the small print, not regulated. Then we have commitment. So commitment is how much commitment are you making, your business making in terms of commitments it's making to the lender and you personally. And really important takeaway here is the concept of personal guarantees. So very commonly in certain areas of finance, not all, but in certain areas of finance, you're required to give a personal guarantee. Now what that means is if you have a company, a limited company, LTD, then we have the theoretical concept of limited liability. That's what it means. It means that the company is at risk if things go wrong to the lender, but you as the individuals and the directors and the owners behind the business should be protected. A personal guarantee strips that away because it basically says you as a person are personally guaranteeing that loan that the company is taking. And that can, in certain circumstances, lead to your house, for example, being at risk. So we have a very jargony world I live in, unfortunately. PPRs, we talk about principal and private residence. That's your home. So please make sure you understand personal guarantees if you're giving one, and do get legal advice because it can cost you dearly. Doesn't mean it's always a bad idea to do a personal guarantee. Sometimes it's the right thing for your business, but you must understand what you're doing. And then finally, certainty. So something that's commonly said in the industry, sometimes about the big banks, is that people say they'll give you an umbrella when it's not raining. So otherwise they might give you an overdraft, but when the markets get bad, they take the overdraft away. So it's important to understand the level of certainty you have in your finance. In other words, if your business has a bad patch, loses a contract, for example, can they just take the funding away and leave you in a terrible situation? So do you understand the certainty, the commitment that they're making to you is important too. So hopefully that's useful in kind of a good framework of how to think about funding before you actually go and get funding. Now, next we're going to talk about the types of funding available in the market. So if we can move on. So yeah, in the end, one way to think about business lending is that it's not massively different to lending to us as people, consumers. The main types of finance are very similar. and the kind of concepts of how you'd think about those types of finance when you use them and why is quite similar. So, for example, I think we can all guess what's the biggest form of finance to ordinary people in the UK. Well, with our housing bubbles, it's mortgages against people's homes. By far the biggest form of finance to ordinary people is residential mortgages against people's homes. Well, unsurprisingly, it's the same in business lending. Commercial mortgages, which is mortgages against business premises, so factories, hotels, shops, is by far the biggest form of finance in value terms to businesses in the UK. What's the second biggest form of finance to us ordinary people as consumers? It's car finance, unsurprisingly. Most of us buy our cars on finance, so it's the second most valuable asset we tend to own. Well, unsurprisingly, it's kind of the same in business lending. Lending against vehicles, trucks, vans, etc., as well as the likes of machinery and coffee machines, equipment, is the second biggest cause and source of finance. So we'd call it in the industry asset finance, that's what we call it. Our American cousins would call it equipment finance, but it's funding against the physical things you need to run your business, whether it's a truck or a coffee machine. So yeah, and of course for the day-to-day, those of us who had decent, reasonable credit scores as individuals, what do we have for the day-to-day? We have an overdraft. Well, businesses have overdrafts too, and we have credit cards too. But as we'll get into the nuances and detail, those things don't quite work the same as the consumer segment. So let me go just briefly left to right. So firstly, business overdrafts. Business overdrafts are very similar to personal overdrafts in terms of how they work, but there is one big difference. The availability of overdrafts to small businesses in the UK has collapsed in the last 10 years or so. It sounds like a really big statement, heuristic statement, but it's true. So there was a period after the global financial crisis, after the banks got into trouble, where the overdrafts were falling to businesses were falling by £5 million every day. So many tens of billions of overdraft provision went away. And unfortunately, that never came back. So business overdrafts are a great tool for your business, but unfortunately, they're much harder to get, certainly than they were before the global financial crisis. But they work. If you can get one, they work very similar to how it would as you as a person. Then we have business credit cards. So these are very similar, again, to personal credit cards. The differences are they may have some good features like that you might integrate with your accounting software to make your bookkeeping easier. And the rewards, the cashback rewards may be more relevant to your business and maybe discounts on things that actually businesses do, like buying stationery. But fun fact and slightly depressing fact actually is the most common form of finance for businesses in the UK is actually a personal credit card. So in other words, it might be a newsagent going to buy some stock from the cash and carry, they'll just use a personal credit card. Now, why is that slightly depressing? A, they're not necessarily using a product that has the right benefits for their business, but also it means they're personally liable, even if they're a limited company, because it's a personal credit card. But personal credit cards are very commonly used. Well over 1 million businesses use them in the UK to fund their businesses. Then we have unsecured loans. So these are loans where it's like a personal unsecured loan. You're not offering anything. You're not buying a physical asset with it. They will commonly require personal guarantees. So we briefly touched on personal guarantees. If you're required to give a personal guarantee, please understand what that means. There's multiple surveys showing that many business owners don't understand what it actually means, actually underestimate how risky it is to give a personal guarantee. Then you can fund against your sales. What does it mean? It means your future sales you can use as a source of funding. The most commonly known version is invoice finance, often known as factoring or invoice discounting. This is when you're a business that trades with other businesses and you can basically release cash on your future invoices before they're paid. Your invoices before they get paid by your customers. So in that painful, often 45 days, sometimes 60 days you're waiting to be paid, you can get the money up front. But there's similar products for business to consumer, so shops, restaurants, etc., hotels, and they fund against the money that's coming into your card terminals, or if you trade online, they fund against the revenues from your online business. And I've already talked about the final two, so I won't spend much time, but asset finance is funding against things like trucks, machinery, coffee machines. It's a very large form of finance, and actually it works quite similar. There's hire purchase, there's equivalents to PCPs if you bought a car on a PCP. So it works quite similar. If you understand how car finance works, you understand asset finance, but again, not necessarily regulated. And finally, commercial mortgages, by far the biggest form of finance in terms of value against your property. There's two types of commercial mortgages. One is when you have a mortgage on your premises that you operate in as a business. The other is when a landlord owns a premises that you rent. They're the ones that has the mortgage. So hopefully that's a useful whistle-stop tour. There's actually dozens of different lending products and there's hundreds of providers. So there's a lot. I could spend all day talking about this, my pet subject, but hopefully that's a useful overview of the market. Thank you very much.
Okay, good morning, everybody. Paul Sullivan here from the British Business Bank. Thank you, Caroline. Thank you for moving those on. Just a brief introduction about myself. Like Conrad, I spent most of my career, if not all of my career, working in finance with small businesses. The last 7 years, I've been working with the British Business Bank, and prior to that, I spent 34 years with Lloyds Bank. So I'm coming at this from having dealt with businesses pretty much from day one of my finance career. What I want to do over the next few minutes is just give you a very high level view of who the bank are, what they do, and we'll get into more detail with the conversation with Sian as we move forward later in the call. So for those of you that don't know, the British Business Bank is the UK's economic development bank. We are put in place to break down those barriers of businesses accessing the finance they need across the depth and breadth of the UK. And that's whether they're starting up, whether they're scaling up, or whether they're just looking to grow. Next slide, please. The mission that we have is about driving the economy through the SME base. You will have heard many times, I'm sure, that the SMEs are the lifeblood of the economy in the UK, and that's why we want to concentrate on them. And it's about driving that growth in a sustainable way to create prosperity across the country. And we're also looking at supporting businesses through their transition to net zero. Next slide, please. So as I've mentioned, we are 100% owned by the government. So for us, we're a PLC, but we're owned by the Department of Business and Trade. However, we are completely independently managed. So our board decide the direction that we're going to go based on what we know needs addressing within the market. What we do is we bring expertise as well as some capital into the business to help enhance the smaller business finance market. We don't lend or invest directly to business. Sorry, could you go back one, please? Yeah, we don't lend or invest directly to those businesses ourselves. All of our work is done through well over 200 partners, such as banks, including Alica, leasing companies, venture capital funds, business angels, web-based platforms. It's about encouraging the existing players in the market to do more. And those businesses, therefore, access the capital they need through the partners. And what we've done is we've enabled them to actually do more within the marketplace, because very much what we hear in the marketplace is that businesses very often don't know what their finance options are. They look at a very limited number of them, and there are a good number that they can look at, as Conrad has just highlighted. Once they've decided on a type of finance, they don't know where to go. And then they also don't know what to do to prepare for it. And that's really covers all of the work that the bank does in trying to help businesses go forward. It means that the capital that the bank has, which is public money at the end of the day, by the time it reaches businesses, has been amplified so that the amount of funding that businesses can access is much bigger than it would have been without our intervention. Next slide, please. Okay, I mentioned why it's important for us to support the small and medium businesses in the UK. There are over 5.5 million of them. And the business population is entirely almost made up by those. The number of employees that sits in there and its impact on both employment numbers and also the turnover within businesses is hugely important. And businesses can't achieve that growth and employ those people without having the right level of capital within their business to do so. Next slide. So I've mentioned briefly how we operate. One of the important parts of my role as I work out within the regions within the bank is to understand what's actually going on in the finance market at the moment. We need to fix what's not working. So to do that, we need to talk to banks, lenders, investors, anybody that supports business, including the FSB as well, to get their view on how easy or not it is for businesses to access funding and finance in the marketplace. If we identify a gap, we bring in a partner who can demonstrate to us that they can help fill that gap. Our combined expertise designs a solution to go out and make that finance market work better for businesses. As you can see, the partners that we work with are across a wide range of types of organisations that are out there, and money from these delivery partners goes in alongside the public money that comes in from us. And as you can see on the sort of top right of that slide, it's a not an inconsiderable amount of funding that's now reaching businesses because our programs have enabled that, and that wouldn't have reached businesses without our intervention. Next slide, please. This is just a very small number of the businesses that we actually work with some logos on there. And yes, Conrad, you can see that Alica's orange bowler hat is there on the left-hand side. But as you can see, it's a very wide range of organisations that we work with, ranging from those that will be household names and that you will know, ranging to some much smaller funding and finance companies. And that's deliberate, because when you work with all shapes and sizes of funders, it means that we're giving a much wider choice of options of both provider and the type of product that's out there, which is hugely important, because no two businesses are the same, so no two business finance needs are going to be the same. So we've got to work with a whole wide variety of people to help provide that. Next slide. There's an element of the bank's work as well that is away from actually just providing the finance tools that are out there. We know that there's an awful lot needed for businesses out there to thrive and survive. So we use our position as a government-owned organisation to build this centre of expertise about what's actually going on in the market. Now, a lot of the publications that we make do go into government, but are also published widely to look at how the market is operating. And that shows not only where we're concentrated as an organisation, but where further efforts are required to actually pick up some of those shortfalls. Next slide, please. Because of our position as the government's economic development bank, we can call in the very best people to help us pull some of this information together in these reports. And this slide here shows a few of the people that are collaborating with us in terms of pulling some of that information and guidance together, but also helping us design some of the solutions that are out there as well. Next slide. As I mentioned, we know that as a business owner, you need to wear very, very many hats. Finance and access to finance is one, but there are a lot of other skills and a knowledge base that you need to build a successful business. We've started to develop our business guidance library, which is an ever-growing suite of guidance notes on all subjects involved in getting your business going and how you keep your business going. We are adding more and more articles to this guidance library by the week. As soon as we understand that there's something that businesses need some guidance on, we start to build that in. We go out to some of the people on the previous slide, but also others to help us build those documents so it can be a trusted source of the right level of guidance. And the link is on this slide, but it'll also be on the links that come out to you afterwards. Next slide. And this is just to show the volume of articles that are within that library at the moment and a number of the subjects that sit there. And as you can see, we've got a huge number of views going into that, and we want to carry on driving that because we see ourselves very much part of this centre of expertise as being a trusted source of some information and guidance for the businesses that are out there. Next slide, I think. Is that it? Yeah, I think that's it. Hopefully it's not frozen everybody's end, but it has on mine.
Oh, thank you to both Conrad and to Paul for setting the scene and providing some context for our discussion. Now, we're going to jump straight in with some questions. So, Paul, I'm going to ask you, businesses often struggle to get finance. What does the BBB do for these businesses?
Yeah, I think as I've kind of picked up, the whole premise of the bank being created in 2014 was to start to address that. The market reflected the fact that too many businesses looked at very limited options of how they funded their business going forward, and it was quite apparent that we needed to find a vehicle to actually create more options for them. If you look at what types of businesses struggle to get funding and finance, if you're starting a business, it's very difficult sometimes to find the right level of funding to do that. Banks, and particularly the traditional banks, would look at businesses that were well established, could ably demonstrate that their business was profitable, and at the end of the day, the business could demonstrate that they could pay back the money that was being borrowed. For startups, that's hugely difficult to do because they don't have that track record. They are by definition starting something new. So the Startup Loan Programme was created for that, and that is a program that's been going actually longer than the bank. It was absorbed into the bank when we were created in 2014, but it's a vehicle to help those businesses that are just starting out. And it's effectively lent to the entrepreneurs on a personal basis. So it's not lent to the business, it's given as a personal loan to get the business moving. But it's absolutely vital to get those businesses moving, get them along their funding journey and moving forward. And the average loan within the startup loan program at the moment is under 10,000. So it shows that it's a relatively modest amount that is needed to move that forward. And that scheme has been set up on the understanding that people may have been out of work for a while. They're starting something new. They may not have the capital behind them to move it forward. So it's absolutely there to provide impetus for that. We also recognise that for businesses that have been about longer, that again they may struggle, particularly if they've gone through a lean patch in terms of their income, etc. So we have government-backed loan schemes. The Growth Guarantee Scheme, which Alika are part of, is there to help lenders say yes to more businesses. So it's where loans may not actually meet 100% of the criteria that they have existing, but lenders that are part of that scheme, and there are nearly 60 of those that are there at the moment, can use the Growth Guarantee Scheme to actually turn some of those no's into a yes. Why do they do that? Well, we're sitting behind that, providing a guarantee to the lender to say that if you're part of this scheme, the bank will take some of the risk should that business fail. And we're starting to see some real traction with that loan scheme out there, and it is making a real difference to some of those businesses that would struggle.
So based on your
the last bit is something that we picked up with some of our latest funding, which is recognizing that smaller loans are also really difficult to get. So you're looking in the sort of sub 100K space. There are organizations out there called community finance institutions, CDFIs, community development finance institutions, and they are there specifically to look at businesses who have approached other lenders and have not been able to get through. And we've had some funding from government to help create and develop more of those CDFIs out in the region. So they are there now providing an additional option for some of those smaller requests that don't fall within the appetite of some of the other lenders that are out there. So there's a lot going on in terms of understanding that it's challenging raising money and what we can do to help correct that.
So based on that answer, can I just clarify, as you are a bank, is it mainly loans and debt-based solutions you work on?
No, it's not. The word bank in our title refers to the fact that we're the economic development bank. So we work very differently to Wade Conrad and his colleagues in Alika would. So we do also look at the other side of the funding coin, which is those businesses that want to raise equity to move their business forward. And that can range from business angel finance through venture capital and into private equity. It's a type of funding that's not particularly well understood. Those people on the call that have watched Dragon's Den, that will give you a little bit of an idea as to what to do, but it's not the full picture. And you have to remember that that is a television program where a process that can take quite a long time to put together is shoehorned into 45 minutes for our entertainment on TV. But it is very much an important part of the funding and finance landscape, particularly for those businesses that are creating something new, innovative, could be in life science, it could be around drug discovery. And they are types of businesses that require funding over the longer term, where actually borrowing money isn't the right way to do it. So actually bringing an investor on board, yes, they will take a piece of your business, but they will be providing much more than the capital. They're providing expertise, they're providing connections. They want to work with you hands-on to help provide that solution that you're bringing to the marketplace. So in a nutshell, we look at all the types of funding that are out there from across debt and equity. The one thing that we don't do is grants.
Brilliant. Thank you, Paul. And Conrad, how do funding options differ for smaller businesses versus larger SMEs?
Yeah, I think the key difference is that the range of types of finance available to larger SMEs is wider. There's some very specialist products, but the kind of process of achieving finance is much more complex and much more laborious. So that's kind of the soundbite. Just breaking that down a bit. So for really small loans to businesses, let's say £10,000, then how lenders make their decisions is not dissimilar to how they make consumer decisions, us as people. We have very sophisticated credit reference agencies. It's actually almost always the same names. There's a couple of names that only do business credit, but they are very good at what they do. The UK probably is, second only to America in terms of the capability of credit bureaus, as we call them in the industry. So a small loan, they'll be looking at the credit worthiness via a third party. I would make the point, it's an important point here, that for smaller lending, the person behind the business is a major factor in the lending decision. By the way, it's also a factor in larger lending, but it's a big factor in smaller lending. So your personal credit rating will directly influence the ability of a very small business to achieve finance. And that is because a really small business, typically, one person, two people, the person and the business are kind of inseparable. Now, I know that many of us have bad credit ratings because they've had difficult circumstances. And in other words, there's not much you can do about it other than rebuild from where you are. But if you have an avoidable poor credit profile for whatever reason because of poor administration, then really work on that, because it will have a real impact on your ability of your business, if you're a really small business, to raise funding. For larger businesses, the range there's a wider range. The big high street banks have, largely speaking, shut down what the industry calls specialist lending divisions. So funding against invoices, for example, half of the big banks don't really offer that to SMEs anymore. They used to. So the wider range, but it's a much more intense process because the amount of money being lent, let's say if they're lending £1 million rather than lots of £10,000 loans, it really matters to them that loan pays back. And they'll be particularly focused on what we call collateral or security, which is how they're going to get their money back if you can't pay. So, for example, if it's lending against your factory, if you're a business with a factory, then it's a mortgage, and they will get their money back by the value of the factory if you can't pay it as a business. So it's more complex, and it tends to be more bespoke for larger businesses in terms of how they look at the funding. So the funding package will often be what we call structured. There'll be multiple elements to it. So it might be that you have a long-term tranche of finance and then a small bit on top that's kind of cash flow for the day-to-day working capital. So they may put together a structured package, as we'd often call it, and they will really get under the skin of the business and understand the business, and may well require you, by the way, to provide up-to-date financial information on a regular basis, so they can keep track of how things are going. So in the end, small ticket lending, they kind of think like a consumer lender. In other words, they think we'll lend against the credit score, and if we do lots of loans, then largely speaking, we know how much money we'll lose. The larger SMEs with larger funding needs, they really get under the skin of understanding whether that business can pay back that amount of money.
So what sort of information am I likely to be asked for by lenders? Can you elaborate?
Yeah. So again, that kind of depends to some extent about how much you're borrowing, and how much you're borrowing in reality depends a lot on how big your business is. So they're looking at the affordability, just as somebody who earns £250,000 a year can afford to get finance on a Mercedes, but us ordinary people, we can probably afford a Ford Fiesta. So it's no different. What we can afford depends on our financial circumstances, and the outgoings and ingoings that we have in our accounts is no different. But largely speaking, for the larger lending, which is typically larger SMEs, they really will get under the skin of the business. They may well be asking, for example, for financial forecasts. So in other words, if your business is asking for more debt because it wants to grow, let's say you're a haulage company, you've got 5 trucks and you're getting a 6th truck, they want to understand how is the 6th truck going to be paid for. So it's not replacing your oldest of your 5 trucks, it's a growth. So you may have won a new contract. They want to get under the skin of that. They want to understand how exposed you are if the contract goes wrong. So they'll get under the skin of the business. And as I talked about before, they'll very commonly ask you to provide regular management accounts, as we call it in the industry. They'll also look at asset and liability statements. So looking at what the business owns and what you own as a person. And on the latter point, that may lead to them saying, I want a personal guarantee, which means that you are personally liable. So your home may be at risk, even though you have a limited company. So we talked about that earlier. For the smaller ticket lending, actually one of my slight bugbears is quite often you'll read websites saying that you should have a detailed forecast and up-to-date accounts. And it kind of gives a sense you're going to go and sit in front of a bank manager, Captain Mannering, and discuss and debate whether you can have a £10,000 loan. The reality is that's not really how the world works for smaller lending. It may have been back in the days of Captain Mannering, I don't know. But the reality is just not economic in the eyes of the incumbent, the big high street banks to do that. And their lending decisions tend to be quite centralized now, rather than being Captain Mannering in a branch. So for that reason, as I said before, things really do matter, like your business credit score, your personal credit score. And by the way, there's lots of service providers. We all know we can go and see our personal credit score because we've been bombarded with adverts and solutions, and tens of millions of us do that. There are solutions for business credit scores as well. So if you're thinking about you might need funding in the future, why not have a look today? Because there are actionable things you can do. Yeah. You can provide more information. You may find that something's harming your credit rating that's perfectly solvable. You just didn't know it was there. So you can go and look at your credit score for free in some circumstances, just as you can as a consumer.
Thanks, Conrad. And Paul, can I bring you back in? So businesses, we know, often struggle to get the right guidance when thinking about finance. Can you give us a bit more detail on what the BBB do to help us?
Yeah, absolutely. It's hugely important because we still find that far too many businesses are taking their guidance, if you like, from maybe another business owner that they talk to in the pub about what they did. It may not have been in the recent past. It may be based on a negative experience that they've had. And unfortunately, we do see that businesses make not the right decisions in terms of their type of funding they go for, who they go to at that time. So I mentioned when I went through the slides that our guidance library is very much aimed at that. There's a lot of detail on there about if you need to pull together a business plan, what you need to do, what needs to be included in it. If you do need to produce some financial forecasts, why is it that you're being asked that? What is it you need to demonstrate? There's nothing short of a right answer being, if you identified somebody that you think might be lending money to your business, have that conversation with them early. I'm sure Conrad would agree with that. It's never too early to start to talk to a prospective funder about what you might need. Time is a hugely important part of that. But we're trying to pull together more and more guidance to sit there to help businesses as they move forward. Government are also trying to do that. There is a newly launched website on the uk.gov website, which I'll make sure that goes out in the links as well, which is bringing together that and some of the other free to access support that's out there, because all of our information is there free to access, but there are people like the growth hubs that sit out there that are able to help businesses with that. So it's about signposting and making sure that businesses can see what's out there and then hopefully dip into that and get themselves better prepared for that funding.
And Conrad, just to go back to you, what are the different types of lenders in the market, e.g., high street banks, etc.? Can you elaborate?
Yeah, I'm actually I've been hitting the people with lots of industry jargon, but in many ways it's useful to understand how the industry talks about itself. So in the industry, we talk about tiers. So tier 1 is the big high street banks. So why are they the big high street banks? Above all else, because most of their target customers bank with them. Therefore, rightly or wrongly, those customers will typically first go to that big bank when they're looking for finance. So the tier 1, that's the big high street banks. In smaller business lending, before the global financial crisis changed things, there was a wide range of lending products I talked about. For example, it was very common to be offered factoring and asset finance against your machinery and trucks. Actually, some of the big banks have actually really pulled back and in some cases shut down those divisions. So the range of lending products available from the big banks is markedly lower than it was 10 years ago as a result of the global financial crisis. And that's led to a thriving alternative lending sector, as we call it. The tier 2, as it's called, is the challenger banks. So they are still banks, but they're not big high street names. And indeed, many of them, including Alika, although we have people around the country, we don't have branches. So our Captain Mannering is on an e-scooter with an iPad. So we do relationship banking, but we don't have the branches. So the challenger banks, the second tier, there's kind of a pecking order, banks and non-banks in the industry, and I'll talk about the technical reason for that in a second. So those challenger banks, believe it or not, the majority of lending to SMEs in the UK is now from those challenger banks. And actually, I've kind of lived that journey because I founded a startup that's focused on serving the alternative lending segment and helping small businesses, and kind of I've seen that journey from being a small minority of the market to being the dominant part. So key takeaway there is, don't think that the main lenders in the market of business lending on that, or the high street banks. That was true 10 years ago. It's not true now. It's the challenger banks like Alika, but we're clearly not the only one. And then they have the non-bank lenders, what we call tier 3. Now, the reason they're kind of the third tier is because they have to borrow money very often from banks that they then lend out, which means that they have to, there's kind of an additional cost that they have, whereas banks are lending ordinary people's deposits, their savings. So they have an inherent disadvantage. They tend to focus on specialist types of lending and some of the lending cases where things are slightly closer to the wire in terms of risk. So that's how we talk about it: high street banks, challenger banks, and non-bank lenders. And there's hundreds of non-bank lenders, by the way, when you add them all up. But the key takeaway is the challenger banks are now a bigger part of the market. So don't think of them as a second choice, perhaps think of them as a first choice. They get pitch. And please don't give up just because your big bank doesn't get back to you or says no, because there's, as I say, the majority of the market has actually moved away from them now. So that's how the market breaks down. Hopefully that's useful.
Yeah, absolutely. So my question from that is, how do lenders decide whether to lend to you?
Well, you know what? If you join banking as a graduate or straight out of your GCSEs, and you go into banking, particularly business banking, and boot camp, as people tend to do on the graduate schemes, there is an acronym, and everyone gets taught the same acronym. It's Campari. Now, if you're as old as me, there was a time when Campari was this really glamorous drink that you'd envision people sipping in the first class of British Airways Air, the Concorde or something, right? These days you don't hear it so much, but Campari is a drink for those younger than me. So what does that acronym mean? The C is character. They want to know the person behind the business or the people behind the business. For the smaller businesses, they really do that with a credit score now, your personal credit score. For the larger businesses, they're really going to get under the skin of you as a person. And in many cases, they're going to look you in the eye. They're going to come and see you and they're going to look you in the eye. Okay? They really want to know the person behind the business for obvious reasons. Ability. What's your capabilities as a business owner? Are you somebody who's founded and successfully run the business for 20 years? Well, it's clearly a lot less risk than somebody who's literally just taken over a business and that's their first time. Means, what's your ability to repay? They're kind of looking at you can guess what they're looking at. It's money going in, money going out. So how much profit you're making, and also the important nuance that how much cash is your business generating, because a business can be profitable but actually burning cash. And unfortunately, very often the most successful, fastest growing businesses actually get into trouble because they don't understand that reason. Then the P in Campari is purpose. What's the money for? So I talked about that a lot earlier. Is it seasonal trading? Is it investment for long term? Amount, I don't need to explain the amount. Repayment, how are they going to repay? What does the repayment look like? Is it monthly? And an important nuance here, you can get lending where you basically only pay interest on the balance, but at the end you have to find a way to repay the balance. Or you can get what's called an amortizing loan, like most mortgages, where over time the balance you owe reduces. So repayment's important. And then the final one is insurance. So what is there when things go wrong? Personal guarantee is one example. You may actually have insurance itself against the business. So Campari is what we're all taught. And Campari these days is largely done by algorithms in computers rather than individuals. But for larger businesses, you will have someone come and Campari you.
Brilliant. Thank you very much. I'm thirsty now. Paul, if I can go back to you and just ask, how is the bank's work going to develop in the future?
Yeah, that's a great question, because obviously our work is not done. Far from it. There are still too many gaps in the market, and there's still too many really good businesses that are not able to access funding and finance. At the recent spending review, we were very fortunate to receive additional funding from the government to carry out this work. So it's now at record levels in terms of what we're doing, which means that some of our existing programs are going to be extended. So the growth guarantee scheme that I mentioned earlier has now been extended to 2030. That's fantastic because it gives us a nice long runway now, means we can talk to new lenders potentially to bring them into the scheme. With it potentially ending in March this year, which was the original time frame, we obviously couldn't bring new people in at that stage because there wouldn't have been enough time for them to operationalise, have an effect. So you've got that, you've got the startup loan scheme that's having some enhancements to it and additional funding. Plus we'll be given additional money to carry out our work in terms of investing in funds. to move the equity side forward, but also additional money to work with lenders and encourage those lenders to do that. Conrad mentioned a lot of the non-bank lenders that have to go to the market to borrow money to then lend on. A lot of the work that we do will work with some of those non-bank lenders to help make them appear better within the finance market by maybe putting a government support behind them, so they can go to the finance market, secure money at a cheaper rate, which they then can go out and lend to those businesses, which is what we want them to do. So there's a lot more that needs to be done. We're being given the wherewithal to do that from government, which is great. We now need to start operationalizing that and moving that forward, but there is a lot more that can be done.
Brilliant. Thanks, Paul. Now, I'm very pleased to say we've had lots of questions in our Q&A, so we'll try and get through them. If I can ask Paul and Conrad just to be fairly short with your answers, just so we can try and get through as many as possible. So the first one, Paul, I'm going to ask, what should a disability finance manifesto include to make support fair, accessible and transparent?
There is actually a code of conduct that's being worked through at the moment called the Lilac Review, which the British Business Bank are partners to, and they're looking at this very important challenge. So that wasn't included in some of the links that I will circulate, but I'll make sure that by the time the email goes out that there'll be some links to do that. It is very much on the pad of lenders that are out there and government to ensure that businesses that fit that criteria are able to access funding and money. So it's kind of in process at the moment. Government are looking at it. The right people are involved in the review itself. So there is something happening along that, and I'll make sure that the links go out so that the person that raised this question can see what's going on.
That would be great. Thank you, Paul. Another question, how is it possible for charity-based CIC micro lenders like Purple Shoots to receive just 1% of the large amount of funds the BBC receives? So
I'm assuming that's looking at somebody that actually wants to lend money to businesses but maybe requires some additional funding to do so. There are programs that the bank runs where prospective lenders can talk to us about what's required to do that. We do have not-for-profit lenders as part of our portfolio of people that we deal with, so it is possible to do that. It's about finding the right program to link in with us and about how the funding is there.
Okay, thank you. Then I've got another comment. Somebody is a member of UKBAA and encouraged joint funding between private equity investors and BritBank. Any comments on that?
We work with a whole variety of people across the equity sphere of funding and finance. UKBAA are absolutely key partners of ours. We work very closely with them about trying to bring more diversity into the angel networks. So the existing angel networks out there, have they got sufficient female founders and female investors on their board? Are they investing in the right number of businesses? Same with businesses from any kind of disadvantaged background or ethnic background as well. So we work very closely with them, and we also work very closely with the funds that sit in there. So it's a key part of what we do.
Brilliant. Thanks, Paul. And another question, how can a limited company that is a CIC find funding? They're saying they find it very difficult.
It is possible to do that. There will be lenders out there that will look at that. We've got a couple of lenders within our partners base at the moment that definitely look at how they can lend to CICs and to charities. The Social Investment Bank is one of them, for example. So we have got those out there. Sometimes with the debt market, if you've got a particular niche and you're struggling to find it, the use of a commercial finance broker can sometimes be the answer. Somebody that can actually spend a lot of time trawling the market for you. And we would always kind of direct people through to the National Association of Commercial Finance Brokers, who have got a finder tool where you can find somebody that can help you do that.
Brilliant. Thank you, Paul. Now, another question, Conrad, I'm going to bring you in if that's all right. We've got a question. How can a startup company with no previous turnover look to get a loan?
Yeah, so, I mean, clearly it's significantly harder for a startup business to get a loan because there isn't that kind of repayment established track record that allows you to demonstrate repayments. So first and foremost, I'd actually point you back to one of Paul's answers, which is the Startup Loan Scheme. Which is administered by the British Business Bank. So Startup Loan Scheme is almost always, when someone asks me that question, in other words, from someone from my network, I say I would go there first. So Startup Loan Scheme is designed precisely for that. Beyond that, there are lenders that will serve that. In other words, private lenders that will serve that. but I would not consider myself an expert in the area, but from what I've seen, I think the use of personal guarantees is very, very common there. So in other words, I think you need to think from your own perspective here, which is if you are starting up a business, the reason lenders are reticent about lending to startup businesses is because there's a very high risk of failure. If you give a personal guarantee to a private lender, then they will personally come after your personal assets, your home and other assets in the event you can't repay. So the most important way of thinking about it is actually the other way around, which is basically, are you aware of the risks you're taking? But yeah, I would personally be thinking startup loan scheme if it was me. It would be my first port of call.
Thank you, Conrad. Another question, how do BBB and Alika tangibly support sustainability and net zero transition of business to ensure real impact versus greenwashing by funding providers? Conrad, can I ask you first?
Yeah, so we it's actually one of my responsibilities at Alika today. Thank you. We have a range of things. So firstly, when we're lending against business property, so factories, hotels, warehouses, shops, then we offer a discounted interest rate for businesses that have an EPC rating, which is an official energy performance certificate rating above a certain level. So the explicit intent of that is to give a compelling reason for businesses to invest in energy efficiency in the buildings that they occupy. And by the way, that sector would represent about 2/3 of the lending that we do, like it is, but also for the entire economy, by the way. That's aimed at our big one. We also do a bit of green lending against renewable assets. So that would be commercial EVs, as they're called it. So the business equivalent of vans that are electric. It would also be some renewable assets, although I wouldn't claim that we're a specialist in lending on solar panels or wind farms. There are some specialist lenders who do that really well. I wouldn't claim that we're one of them. We also, to the best extent we can, do what's called financed emissions reporting. So in other words, we measure the emissions of the indirect emissions caused by the lending that we do. What's the intent of that financed emissions reporting as an industry, as a sector? It's designed to kind of follow the principle of what gets measured gets managed. So whether we are measuring as accurate as we can, pragmatically do, the indirect impact of the lending we do in terms of emissions, and over time it allows us to kind of manage those in the direction that the country wants to go. So that's the kind of range of things we're doing, and I know Paul's going to have 10 times more things to talk about than I do.
Well, I think it's just a case of multiplying the actions and the solutions that Conrad has eloquently talked about that Alika do across all of the lenders that we interact with, because it's very much part of what we do. And before we make any kind of a decision on lenders and investors to work with, they've got to demonstrate that they've got that within their kit bag to do. The bank is also part of the Perseus review as well, which is around reporting of emissions and stuff. So we're very much part of the framework that's out there about helping businesses achieve that net zero status and how we do that and what tools are out there to help businesses do it. Finance is one of them, but there are other things as well. Reporting is absolutely key, and there are innumerable ways of measuring that at the moment. There needs to be some level of standardization across that.
Brilliant. Thanks, Paul. Next question. Decarbonisation often requires patient long-term investment in new technologies and infrastructure. How is Alika Bank shaping its lending appetite to support SMEs that want to decarbonise but may not yet fit traditional risk profiles?
Yeah. I mean, it's a fair question, and I think I should be really open and transparent. The really kind of, let's call it, risky bets in terms of transition technologies. So in other words, the development of or deployment of largely unproven technologies is not something that a bank like Alika would typically be involved in lending to. And there would be some very specialist lenders who because they structure their lending very differently, and would have, for example, what's called warrants, which is the ability to take control of your company if the loan isn't repaid. Not something that we would typically be doing, but some specialist lenders that will be involved in that. But generally speaking, very speculative technology bets, whether it's deploying unproven technology or building it, generally speaking, isn't the domain of banks. Although some of the big banks might do it as a tiny part of their lending, largely for sort of environmental and social governance reasons. So in other words, for the annual report. There may be some specialist lenders operating in that space, but generally speaking, you'd see that as something that you do with equity investment because it's a high risk, high reward thing. Moving into more mainstream stuff, so proven technologies like existing, well understood, well manufactured solar panels, wind farms, water hydro projects. There is certainly a significant lender community operating in the area. It tends to be quite specialised. I wouldn't claim that Alec is specialised in the area. And then the really mainstream stuff, which is, we require electric vans because of the emissions regulations in the town that we operate in. We absolutely would be involved in that because it's a well understood area of the market. It's quite mature now, just as electric cars are kind of coming of age. So the honest answer is, generally speaking, there are specialist banks and specialist lenders who focus on the out there stuff. There is one bank, notably, for example, that's very focused on green lending. I won't mention them out of fairness, but there is one. But it tends to be more specialist activities, my honest opinion.
Brilliant, thank you. And one final question of the day. If you could give one piece of advice for our small business owners about how they can protect their products and their brand, what would it be? Paul, I'm going to ask you first.
Yeah, I think it's come up several times, but finance for business is a hugely important plank in their operation. It's what everything else is kind of built around. If you don't have the cash to do that, you can't move forward. So it's hugely important that appropriate time is given to arranging the funding that you need. It's got to be done at the right time, in the right way, and in the right place, in my view. So it requires a measured decision from a business owner. Regrettably, that isn't always available, but if you've got any control over what you do at all, please do give the requisite amount of time to look at funding and finance and seek the right level of guidance and support while you're doing that.
And Conrad?
Yeah, just building on that. I mean, having been an entrepreneur myself, I know that sometimes you don't have the luxury of being, I'm spending a lot of time thinking long ahead about stuff, particularly in funding, but the fullest extent possible, try and think ahead. It's kind of in that category of important but not urgent, which means that you've always got some crisis or some important client that's dominating your time. You don't quite find the time to deal with it until sometimes it's too late. But in the event that you get caught short, you have to raise money, please do remember it's an unregulated market largely, and do understand what a personal guarantee means. Get professional advice on a personal guarantee if you end up giving one. And Paul, by the way, alluded to this earlier, but there is a thriving community of brokers whose job it is to help you find finance as a business. They're trade bodies, the National Association of Commercial Finance Brokers, and we, like most of our peers, work very closely with them and respect them as an organisation.
Oh, that's great. Thank you both so much. And with that, our time is up. I want to say a huge thank you to Paul Sullivan and to Conrad Ford, and for all of you guys who have tuned in, and especially those who have submitted questions. I'm sorry we haven't been able to get through all the questions, but thank you for everybody who did. Now, we do hope that you have found this session hugely helpful. For anyone who registered for the event today, you will shortly receive an email with all of the links, all of the resources mentioned on the webinar, plus the video to watch again on demand. Also, FSB members, remember you do have access to that funding platform. It is an all-in-one funding platform for small businesses provided by Capitalise. Apply for funding, review your financial health, and check the company credit scores. If you did enjoy today's session, which hopefully you did, I know I definitely learned a lot, then please do leave the FSB a Trustpilot review. And if you're not yet a member of FSB, but you would like more information, please do visit our website. There are so many benefits of being an FSB member, and I can't recommend it enough. Finally, I want to say a huge thank you to Alec Bank and the British Business Bank for all your support with this event and all the links. So to all of you who have joined us today, thank you very much and goodbye.
Thank you.